If you work for yourself in the United States and you expect to owe $1,000 or more in tax this year, the government does not wait until April. Basis 2x. It expects to be paid 4 separate times. Miss one of those 4, and a penalty starts running the very next day, quietly without a single warning letter. Pay a quarter late, and you owe a charge that behaves like interest, not like a fine. It grows for every day that installment stays unpaid, and paying the whole amount in April does not erase the months it was already running. First, does this even apply to you? The test is simple. Add up what you expect to owe for the year after subtracting anything already withheld from a paycheck. If that number reaches $1,000, you are in the quarterly system. Most freelancers cross that line faster than they think. Now, the part almost nobody memorizes. The 4 dates are not evenly spaced. Mid-April, mid-June, mid-September, then mid-January of the next year. Look at that gap. 2 months, then 3, then 4. Then 4! If you assume they arrive every 3 months like clockwork, you will miss the second one. So what is the penalty really? This is where most people picture a flat slap on the wrist. It is not that. It is calculated like interest at the federal short-term rate plus 3 percentage points, and it runs separately for each installment you shorted. Separately for each installment. That word does the damage. The clock on your missed June payment starts in June and keeps running until you actually pay. Guys, the clock on September starts in September. 2 missed quarters means 2 clocks ticking side by side at different speeds. This is exactly why the classic freelancer move fails. You skip the quarters, save hard all year, and hand over one big payment in April. The total tax is correct, but the charge for the months those installments sat unpaid does not care that you eventually caught up. 2 safe harbors exist, and they are genuinely generous. Hit either one, and the penalty simply does not apply no matter how lumpy your income was. First, pay at least 90% of what you end up owing for this year. The problem with that first one is obvious. To pay 90% of this year's tax, you have to know this year's tax. In April, before the year has happened, for anyone with irregular income, that is guesswork, which is why the second safe harbor is the one to actually use. Pay at least 100% of what you owed last year, split across the 4 dates, and you are covered, even if this year turns out to be your best year ever. Last year's number is already known. No forecasting required. One catch on that second safe harbor. If your adjusted gross income last year was above $150,000, the bar rises. You need 110% of last year's tax, not 100. Higher earners pay a small premium for the same certainty. If your income truly arrives in waves, nothing for 4 months, then everything at once. There is a method built for exactly that. The annualized installment method lets you match each required payment to when the money actually landed, instead of pretending it arrived in 4 equal pieces. Pick the second safe harbor, divide last year's tax by 4, and move that amount out of every client payment as it arrives, not at the deadline. And if you have already missed a quarter, pay it now rather than in April. The charge stops growing the day the money lands. WS, education only, not tax advice. A professional who sees your actual numbers is worth the fee.